This is our Forex blog for February 3rd, 2012. And like we do most days, we want to buy the absolute strongest currencies versus the weakest. We want to sell the weakest versus the strong. The real-time strength or weakness of each currency shows up in histogram form. Anything at and above the dotted 80 line is extremely strong if it's green, or weak if it's red. Underneath that, we have the daily, weekly, and monthly trend. So in a perfect world, when you see mostly weakness today in the dollar, the daily trend's down, the weekly and the monthly's down, you want to trade it against a currency that's strong on as many time frames as possible. You can see earlier today that the pound was extremely strong. Daily trend's very strong. The weekly trend's up, but not super strong up, and so is the monthly. The Australians started the day off coming up with some weakness, as did New Zealand, but those have the strongest weekly and monthly trends. So if you see some strength coming back in later, you want to buy those against the weak dollar. So the first and highest odds, because the real time trumps everything else. If the real time is extremely strong in the pound, and the pound's the strongest, then trade that. And the euro is also extremely strong. But between the pound and the euro, the weekly and monthly trend are down in the euro versus, up in the pound. The pound's a lot stronger longer term than the euro, so both being very similar in terms of real-time momentum, I personally would choose the pound to buy against the dollar. So here is the chart for today. We have a narrow range 7 pattern here for the previous hour. It comes up. Here's a Fibonacci area. It breaks out, and you can see it goes up about 10 pips. Pulls back another 15 pips up, pulls back, it's finding support at the fibs, and then it goes up to the previous day's high in our upper containment bands, which most of the time is the end of the move. Notice the low is also containing price, and so these are excellent places to look to get out of your trades and to use as profit targets. 57 here, if you had bought this breakout right here, it's 22 pips away. You risk 10 pips to make 20 or plus pips. That's a good trade. And you can just use our trailing stop. If you got in right here, out about 6 or 7 pips. In here, out with a 5 pip loss. In here at 27, out at 41 for a 13 pip win, and so on. Once a currency goes from above to below the hourly moving average, typically it's going to pull back to the next area of resistance or support in this case, which is the trading zones right here, the monthly pivot. This is the average price of the currency over the previous month. And so it's very strong support. It's also the half number, which also tends to be support. Another way of trading is to use our range charts, which let me just scroll this forward to today. This shows a certain number of pips per bar, and in this case I have it set for 6. And there's a lot of patterns you find on range charts. One of them is a little rectangle pattern. Anytime it goes up and down for at least 5 bars, as of right here, when it breaks out over those bars high, you can go long, and you can see our trailing stop got you out with about 15 pips profit. Usually when currencies pull back and they'll find support at the hourly, you have that same pattern here, up, down for at least 5 bars. You buy the breakout right here at 16, went all the way up to 36. So it went up 20 pips. Most of the time, if you get into trade and it starts going up and it has no statistical strength, and the previous move was very intensely down, that's a trend that's not likely to continue, unfortunately. And if you're an aggressive trader, you might start looking for some sells and then expecting this pullback to the bottom containment band, much earlier. Look, the strength was there, and then it pulled back without that much weakness. It went up with a little bit more strength than the weakness, and then it went down with a lot of momentum. It went up with 1/2 to 1/3 the previous move's down momentum, and that's not a trade that's very likely to continue. And usually the hourly moving average finds support and you get a bounce off of it. When bounces fail to materialize, in this case it went up, pulled back, went up, didn't even go back up to this high, it's very likely to explode down when it breaks through the low here. So this is a pretty safe, high probability place to short, given the previous momentum is to the downside. And I also run a real-time, it's a little bit longer time frame trend than the real-time bar-by-bar analysis here. This shows intermediate time frame trend. And you can see that shifted down even before it broke down by about 20 minutes. Now, remember, the euro-dollar was also strong, but the longer-term trend of the euro against most currencies is down. The dollar is weaker than the euro longer term, though. You can see that's why the weekly monthly trend comparing the euro to the dollar is actually slightly up. You would have bought this breakout right here, small loss or break even, pulls back, finds support, breaks out again. You can see this one that went up about 30 pips. Most of the time they stall at the Fibonacci profit target level, which it went to the pip, to the 1.618. Maybe it went a pip above it. But this is a very high probability place. If you see it going up without that much momentum and it fails, you get a little double top right here. Pretty high probability place to sell. The Australian was weak earlier in the morning before midnight, but the longer term trend is up. And when you see some strength coming back in, you can definitely trade the Australian against the dollar. Let's scroll forward on this chart. I have it 2 days back. So again, coming up to today, this one has a very strong weekly monthly trend. It kind of goes down to the previous day's low and has a false breakout underneath there. Usually when the longer term weekly monthly trend is up and you get a breakdown underneath the hour or underneath the previous day's low or the previous week's low and it fails, you're going to get a counter trend move up. And you can see that the momentum to the upside was a lot higher than the downside. The daily, weekly, monthly trend is up at this point, and obviously this is a news release, but explosive 60 pip move up. If you miss that first trade, wait for at least a 15 pip pullback, get into this trade right here, you have a nice little 20 pip profit there. This is a perfect example for Elliott two-wave pullback. Anytime you get a pullback, usually the second wave, if it goes down to the first or second fib target, is a good place to get in. You want to buy when it goes above the bar's high. In this case, it hit the 1.618. With this kind of very little mild weakness on the way down compared to the strength, very high probability place to get in. In that trade there is also good for 40 pips. So watch all of our videos on our site, understand our systems that we trade, and when you spot this pattern, especially in the super strong currencies where all the time frames are up, this is a no-brainer trade right here. If you get one or two trades like that a week where you get 30 pips on one, 40 in the next, that's 70 pips. If you can pretty much break even on all the rest of your trades, 70 pips a week is 280 a month, and you'll double your account every 6 weeks. So, all it takes is, spotting certain high probability trades and catching some big wins on it. The rest of your trades, if you have break evens, some small wins, small losses, you'll be doing fine.